Warren Buffett is widely regarded as one of the best investors of all time, but if you asked him who he thinks is the greatest investor of all time, he would most likely choose his instructor, Benjamin Graham. Graham is widely regarded as the father of security analysis and value investing. He was an investor and investing guru. In this video, we will be taking a look at the top investing strategies that this man uses every day in his life. Let's jump right into it. Principle number 1 is always invest with a margin of safety. The notion of buying an asset at a considerable discount to its intrinsic value is known as margin of safety, and it is regarded to not only create high return chances, but also to reduce an investment's negative risk. Graham's objective in basic terms was to purchase assets worth $1 for 50 cents. He did a fantastic job with this. These company assets might have been significant to Graham because of their consistent earning capacity or because of their liquid cash worth. Graham, for example, was known to invest in firms whose liquid assets on the balance sheet, net of all debt, were worth more than the company's whole market valuation, also known as net nets to Graham followers. Graham was practically buying businesses for nothing as a result of this. This was Graham's normal investment approach, despite the fact that he had a variety of others. This is an important idea for investors to understand, since value investing may result in significant rewards once the market re-evaluates the company and raises its price to fair value. It also gives protection on the downside in the event that things don't go as planned and the company fails. Graham's success was built on the safety net of buying an underlying firm for a fraction of its true value. When these inexpensive equities were properly picked, Graham discovered that additional declines were rare. While several of Graham's pupils were successful utilizing their own methods, they all agreed on the need of the margin of safety. Principle number 2 is expect volatility and profit from it. Dealing with volatility is a part of investing in stocks. Instead of fleeing the market in times of stress, the astute investor views market downturns as opportunities to locate fantastic assets. Mr. Market provides investors with a daily price tag at which he will either buy out or sell his part of the company. He will occasionally be enthusiastic about the company's future and quote a high price. Other times, he is pessimistic about the company's future prospects and offers a cheap price. The lesson here is that you shouldn't let Mr. Market's opinions dictate your own emotions, or worse, lead you in your financial decisions, since the stock market has these same feelings. Instead, based on a solid and objective evaluation of the facts, you should make your own assessments of the business's value. Additionally, you should only buy when the price offered is reasonable and sell when the price gets excessive. To put it another way, the market will vary, sometimes violently, but instead of fearing it, utilize it to your advantage to find bargains in the market or to sell out when your assets become significantly overpriced. Graham proposed 2 ways to alleviate the detrimental consequences of market volatility. The first is dollar cost averaging. Dollar cost averaging is done by purchasing investments in equal dollar amounts at regular periods. It takes advantage of price declines and eliminates the need for an investor to acquire the entirety of his or her stake at the market's peak. For passive investors, dollar cost averaging is beneficial since it relieves them of the task of deciding when and at what price to acquire their investments. Number 2 is investing in stocks and bonds. Graham advocated for balancing one's portfolio between stocks and bonds to protect money during market downturns while still obtaining capital growth through bond income. Remember that Graham's idea was to protect money first and then to strive to develop it. He recommended investing 25% to 75% of your money in bonds, with the percentage shifting depending on market conditions. This method also has the added benefit of preventing boredom, which can lead to the desire to engage in unproductive trading. Moving on to principle number 3, know what kind of investor you are. Investors should be aware of their own investment self, according to Graham. To demonstrate this, he created obvious contrasts between major stock market groupings. Active and passive investors, which are referred to as enterprising investors and defensive investors by Graham. You only have two actual options. The first is to devote a significant amount of time and effort to become a skilled investor who considers the quality and quantity of hands-on research when calculating the projected return. If this isn't your cup of tea, settle with a passive, potentially lower return in exchange for significantly less time and effort. The academic concept of risk equals reward was thrown on its head by Graham. Work equals return is how he sees it. The more time and effort you put into your investments, the better. Investing in an index is a fantastic option if you don't have the time or willingness to undertake thorough research on your assets. According to Graham, a conservative investor might obtain an average return by buying the Dow Jones Industrial Average's 30 equities in equal proportions. Both Graham and Buffett agreed that achieving even an average return like the S&P 500 is more difficult than it appears. According to Graham, many people believe that since it's so simple to earn an average return with little or no effort through indexing, then a little more effort should provide a somewhat greater return. The fact is that the majority of individuals who do this do significantly worse than the average. In today's words, a defensive investor would be someone who invests in stock and bond index funds. In essence, they control the entire market, profiting from the best performing sections without having to anticipate them ahead of time. By allowing the stock market's overall outcomes to govern long-term returns, an investor is essentially assured of the market's return and avoids doing worse than the average. Beating the market, according to Graham, is far easier said than done, and many investors still fail to do so. There is another category of an investor type, speculator versus investor. Not everyone who works in the stock market is an investor. Graham thought that determining whether people were investors or speculators was crucial. The distinction is simple. An investor considers a stock to be a component of a firm and a shareholder to be the owner of that firm. But a speculator considers himself to be gambling with pricey pieces of paper with no inherent worth. For the speculator, the asset's worth is solely decided by what someone is willing to pay for it. To paraphrase Graham, there is intelligent speculating and intelligent investing. The trick is to know which one you are best at. Well, that wraps up today's video. Benjamin Graham is a very experienced investor and is the teacher of the well-known Warren Buffett, so he clearly has some tricks that can make sure you succeed in investing. Make sure to like, subscribe, and hit the bell for more finance videos.